Well, gold and silver prices are continuing to climb, and the economy here in the U.S. is chaotic. Is it good? Is it bad? Is it strong? Is it weak? Well, during all this chaos, gold is emerging as the anchor global asset, and silver's setup cannot be ignored. That's what we're going to dig into in today's video. So thank you for joining me. Hope you are doing well. I'm Ric Bender, and welcome to Finance Lab. As you know, economies around the world are proving themselves to be in dire straits. Debt has reached uncomfortable levels, and trust in paper, whether it be paper contracts or fiat currencies, is beyond weaning. We'll often read of a currency crisis, a liquidity crisis, a monetary crisis. We're just living through times that might best be defined as economic chaos. And when it comes to the U.S., and that dominant player on the world's financial stage, well, that too is weaning. In fact, in my opinion, we may actually be watching a reset, a monetary reset before our very eyes. We're seeing now gold held by central banks, more gold held by central banks than treasuries. It seems as though investors are not as attracted to the U.S. debt as they once were. Is this why the Treasury is buying back debt? Well, we're going to dig into that. And I want to conclude with some recommendations from Goldman Sachs in terms of investing in this type of economic chaos. You see, is the economy here in the U.S. good or bad? We are told both, depending upon who you listen to. And is it strong or weak? We're told both, depending upon who you listen to. But a lot of people are making note of the Treasury buybacks as a sign that the economy is really bad. That may or may not be true. Many people are making a big deal that they are doing these buybacks in secret, and that's simply not true. Let's talk about these buybacks for a moment. And there are some questions as to why they are really doing this. So, on your screen, what you'll see is a published schedule of a tentative buyback schedule. The Treasury publishes this. These are not done in secret, just so you know. They also show us the date. For instance, it's Friday the 26th as I record this video. So you can look down and see 9/30/2025. You can see the operation date, the settlement date, the reason why, liquidity support, nominal coupons, the amount, $4 billion. So this schedule is being published. This is not done in secret. The question is, why are they doing this? Well, one of the answers is they are taking, for the most part, long-term debt, and if you will, refinancing, oversimplification, but refinancing for short-term debt. Reason being, the short-term debt, or whatever debt they are changing this into, is to provide a better interest rate, which would reduce the cost of the debt. Now, Treasury is not reducing the debt. They're just simply, basically managing the debt, making the debt less expensive. It's as if you had a 30-year mortgage, principal and interest, taxes, insurance, and you refi that to a 5-year interest only. You wouldn't be touching the debt, you wouldn't at all, but you would be reducing your monthly cost, liquidity support. So this is a way that the Treasury can reduce the cost of the debt without reducing the debt, however. But there's a bet here, because they're moving long-term debt into short-term debt. So does that mean that they believe that when that short-term debt then needs to be refied, that interest rates will be lower then as well? Interesting question. I don't know the answer, but that could be the case. This is all good for gold and silver because it speaks of chaos, unclear direction. Why is the Treasury actually doing this? Just to lower the monthly payment on the debt? Possibly. but they're taking a bet by taking the long-term debt to short-term debt. They're absolutely making a bet because that'll have to be refied again, if you will, or buy back again. So these leave us with questions. Is this good or bad? Well, we're actually not sure. But again, what it tells us is the economy is in question. Did you know we have a free weekly newsletter? Every Thursday morning, we drop content which will be both helpful in terms of building and preserving wealth. In recent newsletters, we discuss topics such as the perfect portfolio allocation. Prior to that, silver's setup, which can't be ignored. If topics like these interest you, then get our newsletter. It's absolutely free and it'll be in your inbox next Thursday. All you need to do is click on the link below. I'd like to conclude with some recommendations from Goldman Sachs to its clients. And what's interesting about this is even within this newsletter, they address the fact that economic data is unreliable. There's just been too many mistakes. But here's what we believe, that we are headed for slower growth here in the US and higher inflation. Goldman's analysts believe the same thing. So here's what they're telling clients. During any 12-month period when both stocks and bonds had negative real returns, either commodities or gold delivered a positive performance. This phenomenon underscores the role that commodities can play in portfolio diversification, particularly when markets are focused on the risk of slower growth and higher inflation. This is where we are headed: slower growth, higher inflation. And because of that, Goldman is suggesting it's time to diversify. And of course, we would suggest diversify to gold and to silver. Hey, thank you for joining me. Hope you're getting value out of our videos. And if you are and you haven't subscribed, consider subscribing to the channel. You may also want to share this with a friend. I thank you again for spending time with me, and I'll see you next time.